In this week's video, we'll compare the present day to 1982, 1987, 1994, and 1999. Those comparisons will help us answer the question, are stocks set up for a 1987 style crash or a 1994 like buying opportunity? To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the broad NYSE Composite Stock Index. This is 1982 here, and this is the broad stock market where my cursor is. 1982 represented an outstanding entry point from a long-term perspective. In October of 1987, the Dow lost 22.61% in one day, and the intraday losses were much worse than that. And we know from recent videos that 1994, the end of 1994, was an excellent entry point as well, similar to 1982. And we also know from past videos that long-term consolidation can see a bullish break or a bearish break. While the dot-com bubble didn't burst until March of 2000, the broad stock market started consolidating in 1998. And you can see this type of consolidation is one of the reasons why risk management was important in February of 2016, because if you break below the box, really bad things can happen. And if we fast forward to the present day, we have another long-term consolidation box. In this video, we'll compare these periods to try to understand the probability of good things happening relative to the probability of bad things happening, including very bad things happening, like a one-day dislocation similar to the one that occurred in October of 1987. Now we're going to walk through the exact same period, but we're going to look at an indicator, monthly ADX in isolation. This is the description of ADX from stockcharts.com. This is a little bit of a simplified and edited description. This indicator has three lines, this black line here, this green line here, and this red line here. This horizontal black line is not part of the indicator. For the purposes of this exercise, we will refer to this black line as black ADX, this will be green, and this will be red. Black ADX measures trend strength without regard to direction. The other two indicators, green and red, complement black ADX by defining trend direction. Used together, chartists can determine both direction and strength of trend. The black line is strength of trend. When green is above red, it's telling you that we have a bullish trend for the most part. And when red is above green, it's telling you we have a bearish trend. Trend strength, these two lines help with trend direction. The creator of ADX was a man by the name of Wilder. Wilder suggests that a strong trend is present when black ADX is above 25 and no trend is present when below 20. So in the early stages, or right before the outstanding entry point in 1982 for stocks, black ADX was hovering around a trendless 18, telling us that we have indecisiveness, consolidation, and confusion with a number as low as 18. Now we're looking at a description of how to use ADX from the book Trading for a Living. When black rallies above both red and green, black rallies above both red and green, it identifies an overheated market. So think significantly overbought or an extended trend. When black turns down while above both red and green, it shows the major trend has stumbled. So we can see here in 1986, when black rallies above both red and green, it identifies an overheated market. So in 1986, ADX is telling us that we should start being a little bit more careful because this is somewhat of an extended market and overheated trend. Black Monday, or the 1987 stock market crash, occurred on a Monday, of course, and it was Monday, October 19th. You can see Black ADX had turned down prior to the crash. The peak here is in the 60s for ADX, and the Friday before the crash, we were down to around 57 and change. So before the stock market crash, we have an overheated market with black above green and red, and we have black turning down while above both green and red. And that tells us, or shows us, that the major trend, which in this case is bullish, because green is above red in this period here, it's telling us when this turns down that the major trend is a little bit more vulnerable or is starting to stumble. And as you might imagine, when stocks plummeted on Black Monday, ADX plummeted as well, because the strength of this trend was no longer extremely strong, and it weakened considerably just in one day. If you had a chance to look at the analysis on short takes this week with this title, you can Google the title here if you want to see it. We talked about that 1993 to 1995 consolidation again, which is similar to the consolidation we have in the present day in December of 2016. So for the purposes of this video, how did ADX look before the big move in 1994 and 1995? This is an excellent entry point here. Did ADX look similar to 1987, or did it look significantly different? Now we've fast forwarded to late 1994, where my cursor is. So similar to 1982, ADX Black was hovering near 18 in late 1994. And for the most part, it almost was below both red and green. That's very, very similar to what we had at the excellent entry point in 1982. A sleepy trend, a sleepy, indecisive market. Wilder told us that any reading below 20 was basically a trendless market. Trendless in 1994 and trendless in 1982, right before the big move. If we draw a horizontal line and attach Black ADX, we can see it's basically in the same place in 1982 and again in 1994. So we can match this up with the analysis on short takes. The bullish moving average crossover occurs here at point A. This is a similar point here. So we have a bullish signal, long-term bullish signal, in a sleepy and trendless market that's been consolidating. What happened next? We broke out of the consolidation box. The longer you go sideways, the bigger the move you can expect to get. And in this case, it was a very, very big move. So 1994 looks a lot like 1982, at least relative to 1987. 1994 doesn't really look anything like 1987. Let's fast forward to the early stages of another bearish period. Remember, we showed that the broad market started basing in 1998 and stocks went sideways in the NYSE composite into the spring of 2000. So we have a similar look here in 1998 to 1987, when Black rallies above both red and green. Black is well above both red and green in 1998. It identifies an overheated market. So think significantly overbought or significantly extended from a trend perspective. ADX monthly is not a good timing tool. It's more of a context tool. What type of market am I in, and what is the context of the other data that's being tracked by the model? We would classify this as somewhat of a confirming and late indicator. We would like to see ADX align with the data inside the model. It's not necessarily ADX that governs our decisions. Taking another quote from Trading for a Living, the single best signal with ADX comes after Black falls below both red and green. When Black rallies from below both red and green, it shows the market is waking up from a lull. That's exactly what happened here. The single best signal with ADX comes after black falls below both red and green. Black is below both red and green here in 1982. When black rallies from below both red and green, it shows the market is waking up. And you can see when the market started to move, it starts to rally here. And in 1984, it rallies above both of them. So these buying opportunities here, the look of ADX is quite a bit different than the higher risk periods in 1987 and 1998. Therefore, it's logical to ask, does 2016 look more like the high risk periods, or does 2016 look more like the favorable entry periods? The answer is 2016 looks a lot like 1994, an excellent entry point, and 1982, an excellent entry point. It really doesn't look anything like these higher risk and extended periods in 1987 and 1998. In all cases, in 2016, ADX Black is hovering near 18. That's a sleepy, trendless market. We're below 20. Wilder tells us when we're below 20, we really don't have a trend. ADX Black hovering near 18 in 1994, and ADX Black hovering near 18 in 1982. Going back to this quote, the single best signal with ADX comes after black falls below both red and green. So we're zooming in on ADX here in December of 2016. Single best signal comes when ADX Black falls below both red and green. In the present day, we have the single best signal, at least the early stages of it. This is a setup here. Black is below both red and green. When black rallies from below both red and green, it shows the market is waking up. Well, it hasn't started rallying yet for the broad stock market. It's just a setup. But in terms of risk and a trend being extended, we don't have an extended trend like we did in 1987 or in 1998. We have a sleepy consolidation-like trend similar to the sleepy market in 1994 and 1982. If we draw a horizontal line, we can see ADX Black is here, ADX Black is here, and in the same place roughly in 2016. In terms of assessing stock market dislocation or crash probabilities in 2016, and it should be noted the probability is never zero, but it's noteworthy. This is the highest risk ADX reading in terms of being extended above green and red. This is the most vulnerable and extended trend that we can find on this entire chart. And in the latter stages of the dot-com bubble, we also had a vulnerable and extended market. These are extremes here with higher risk, especially relative to long-term reward. These are not extremes where your risk-reward ratio is much more favorable. If we pull some of the noise out of the chart, if we compare this to this, and this, the present day 2016 really doesn't look anything like 1998 or 1987. And all that does, it can't predict the future, it just speaks to probabilities. Nothing more, nothing less. Remember, we said at the top of the video that green and red help us with the trend. So black is the strength of the trend. I have a strong trend here. It's a bullish trend because green is above red. How long did we have a bullish trend? Well, in this case, before the 1987 crash, we had a bullish trend for 5 years. Green stayed above red for 5 years. How long has green been above red in 2016? The answer is 8 days. This really doesn't look anything like this vulnerable and extended market. Respecting that this chart will end up being quite noisy, we're going to walk through this chart piece by piece. This is the NYSE Composite 1982 up to 1989 here. So we're zeroing in on what the stock market looked like before Black Monday in 1987 and after Black Monday in 1987. We have the 2-year consolidation box before the big rally. The longer you go sideways, the bigger the move that you typically get. This is the 1987 crash here. This is a weekly chart, but you can see it occurred on a Monday. So we have a massive gap down, and you can see the low for the week was quite a bit lower than the close for the week here. So now we're going to be asking, was there anything that we could see visually, hard evidence, before Black Monday that would have helped us? The answer is yes. We have 2 bearish weekly MACD crossovers on this chart. We can see them, we can measure them before October of 1987, and maybe more importantly, the last weekly signal that occurred, and it occurred before the month of October in MACD, was a bearish signal, telling us that momentum was starting to wane. If we flip over to RSI, weekly RSI, this is the slope of price during this ascent here. Price makes a higher high. Weekly RSI makes a lower high. That's a bearish divergence. And that bearish divergence was in place several months, where it started before October of 1987. This is noteworthy here. This last weekly push higher here, notice it occurs right on this line in October. Look how weak RSI is here. Price is all the way up here. Typically when price gets high, RSI has been much higher. This is a very, very ugly looking push higher in weekly RSI before October of 1987. One of the main topics of this video is buying power. How much buying power have you extended here? The answer is not much. You've been consolidating. When you get up here, you're starting to run out of fuel and you're starting to run out of buying power. And some of these early adopters are going to think about selling as their profits start to grow. So this is beneficial in terms of how much buying power and how long the trend has been going. The last bearish signal with our 3 weekly moving averages are generic and for illustrative purposes only. The last bearish signal occurred 173 weeks before Black Monday. You can see we never get a bearish cross in here. The bullish cross comes on December 10th, 1984 here, and then after that, good things happen. If we look backwards from this point here before the crash, the gain in the market, looking backwards 900 calendar days, was 80%. The stock market went up 80% in the last 900 calendar days before Black Monday. That is a big move, and that has extinguished a lot of buying power and a lot of capital that could migrate into stocks. Our bullish signal here, blue above green and red, was in place for 145 weeks before Black Monday. The crash comes here. Remember, this is a weekly chart, so these are weeks. We get a discernible lower high relative to this high. This high is made in August here, and several weeks later, we make a lower high. And we zeroed in on this chart to make sure it was true. The blue moving average was already rolling over before Black Monday. And this is the close on Friday before Black Monday. Notice price looks different than this period in here. This is the first time during this whole rally that we get a weekly close below all 3 moving averages, and that happens the Friday before Black Monday. Another thing to keep in mind, when you do have strong trends, and you do have strong trends here, typically if you get a dislocation like this, it's not something that kicks off a 2 to 3 year bear market. Typically, anything can happen in the markets. What do we mean? How can that help us? Well, typically when you have the strong trends and you get a dislocation, it's a buying opportunity, because you can see here stocks righted themselves relatively soon and exceeded the high from August of 1987. Similar situation with the flash crash. We had a dislocation in 2010. Those lows that occurred after the flash crash, similar to this low here, turned out to be a buying opportunity. Now let's compare everything that we just talked about to the present day, so we can compare and contrast. Same moving averages, same weekly chart. Now we've got 2013 and the present day here. This is December 16th at 11:33 a.m. You might remember before the crash in 1987, the last weekly signal that we had from MACD was bearish. In the present day, it's bullish. In the present day, the last bearish moving average crossover occurred 56 weeks ago. Compare and contrast that to the 1987 case, which was 173 weeks. Again, think about buying power, how extended a trend might be. Unlike 1987, in the present day, we do not have a discernible lower high. This rally off the low here, the last thing that it did was make a higher high above this cluster of weekly highs here. We currently have a series of higher highs and higher lows, which is the textbook definition of an uptrend. If we go back 900 calendar days from the present day, the broad NYSE composite, this is 900 days before, so my cursor is basically in June of 2014. The gain, looking back 900 days, was less than 1%. It was 0.24%. Compare and contrast that to the look back in 1987, the gain was 80%. This market was extended. This market has been consolidating. The NYSE composite was at 11,131 on December 15th. Way back on June 30th of 2014, was basically at the same place at 11,104. In the present day, our bullish moving average crossover here, for illustrative purposes only, has been in place for 18 weeks. This occurred 18 weeks ago, and we've covered it in several videos since it occurred. Contrast where we are relative to this signal, 18 weeks versus before Black Monday. The last bullish signal occurred 145 weeks ago. Extended, not extended. And in the present day, price, unlike 1987, is above all three moving averages, and the slopes of all three of them are still bullish. Unlike 1987, there are no significant divergences in weekly RSI. And unlike 1987, where the last push higher had an incredibly alarming RSI reading, nothing particularly alarming about this reading here. This reading here is higher than this reading here when the market made its highs in 2015. Here's the 1987 crash here. This table summarizes what we've just covered. 80% gain before the crash, looking back 900 calendar days. 900 days back, the broad stock market has gained less than 1%. Slope of the 30-week moving average, bearish, bullish today. Discernible lower weekly high here. Not in this case, at least not yet. In 1987, the last weekly high was made 9 weeks before the crash. In the present day, we've made a new high this week. The last bullish signal from the 30, 40, and 50-week MAs occurred 145 weeks ago relative to 18 weeks ago. Where was the market relative to a long-term consolidation box? In 1987, we're way above any type of long-term consolidation. In the present day, for the NYSE composite, we're at the top of the box. The three major indices in the U.S. have broken out of their consolidation boxes. Last weekly MACD signal before the crash, bearish. Present day, bullish. MACD bearish divergence, not that big a deal. These yellow ones aren't as big a deal. The red ones are more significant. We don't have that in the present day. This is important. Recent highest high in weekly RSI, 82 was the highest reading before the 1987 crash for weekly RSI. That is an extended market. In the present day, we're not in overbought territory. We're at 65. Recent highest high in monthly RSI in 1987 before the crash, 79 and overbought. Present day, not overbought, 61. Recent highest reading in monthly ADX black, 61, the most extended trend on the whole chart dating back to 1982 before the stock market crashed. Today, we're trendless for the most part. This number says what the boxes tell us. We've been consolidating. Prior to the crash, how long was ADX green above ADX red? 5 years versus 8 days in the present day. Fair question might be, what about valuations? Answer, the present day charts and present day net aggregate opinion of all market participants, they're both well aware of current valuations. In fact, we can't think of any fundamental data point that the market is not aware of. All the fundamental data, including valuations, are reflected in the present charts and data points, including these data points here relative to these data points here. The stock market knew about valuations in 1987, and it's well aware of valuations in 2016. Doesn't mean valuations won't be a problem. The charts that we have in front of us and this data says it's not a problem yet. We don't forecast, we take it day by day. If valuations are a problem, it will be reflected in the data and captured by the model. To give us some idea of what a euphoric bubble looks like, prior to the dot-com bubble bursting in March of 2000, if we looked backwards, 3,355 calendar days, the NASDAQ had gained over 1,000%, moving from 353 to 5132. How does that compare to the present day? The previous chart showed us what a bubble looked like. This is what consolidation looks like. This is the NYSE composite. In the peak, October 2007, it was at 10,387. Before the election, it was below that level at 10,281. Remember, on the bubble chart, price went from the lower left corner to the upper right. If we saw something similar going back to October 9th of 2007 and we followed the NASDAQ's bubble trajectory, the gains would literally be off the chart. If we fast forward to Thursday, December 15th, the gain is 7% over this period, looking back 3,335 days. Point to point, that's roughly a 7% gain. Compare and contrast that to the NASDAQ, looking back the exact same number of calendar days. A bubble gained over 1,000%. Consolidation saw almost no gain over this long-term period, only 7%. This is an indecisive, low conviction slope. This is a high conviction slope. This chart is also kind of noisy. We'll walk through it piece by piece. From Twitter, showed some charts that showed why the expression is harder markets are often followed by easier markets. Notice we never use the term easy, only easier. Why? This is an incredibly strong trend here from the early stages of 2013. The market rallied into the spring of 2015. We examined these 600 trading days in here. This is supposed to be an easy period. There's a lot of givebacks and a lot of volatility in here. In fact, out of the 600 trading days, 335 of them were green in terms of the S&P 500's daily move, and 265 of them were red, meaning on roughly half of the days, within the context of a discernible long-term trend, you felt like you were wrong and you felt like you were losing money. The average gain on the green days was roughly 0.5%. The average loss was roughly the same at 0.5%. The difference is the number of green days exceeded the number of red days. All of this shows us that under our approach, when the market is trending favorably, we need to stay focused on the longer-term primary trend. In this quote-unquote easier period, 56% of the trading days were green and 44% of them were red. You have to be extremely disciplined to stay with this trend. This data also tells us that we learn very little about the long-term trend during a red day or a cluster of red days. Red is part of the equation, and red days and red clusters are to be expected. What's the moral of the story here for us and for our approach? Staying too close to the markets and constantly reviewing intraday percentage changes in the value of our positions can expend a significant portion of valuable and limited resources in the form of mental capital, emotional stability, and the ability to remain focused and disciplined. Humans, that includes yours truly, and it includes Kathy. We can only handle a limited number of stimuli before stress starts to impact our mood, our temperament, and eventually our performance, which means we need to manage these stressors and these stimuli. Since it can eventually impact performance, we cannot afford to waste mental capital on any task that is not directly related to improving performance, and that includes staying too close to the markets, watching balances fluctuate from day to day, and watching the share prices of our ETFs fluctuate from day to day. We know with 100% certainty there is going to be fluctuation and emotional pain, even within the context of a very, very strong trend. Therefore, as we head into next week, it's incredibly important that we let the data rather than our emotions govern our actions. And the only way that we can do that is if we head into next week with that always important, flexible, unbiased, and open mind. And forecasting is not part of the model, and it's not part of the economic equation that we use to make decisions. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes. and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.